Interest rates are fundamental to our understanding of the financial world. They represent the cost of borrowing money, influencing everything from individual decisions to global economic policies. When central banks adjust rates, they aim to control economic growth by affecting consumer spending and investment. Lower rates typically stimulate the economy by making loans cheaper, encouraging spending and investment. Conversely, higher rates can slow economic expansion by making borrowing costlier, which can dampen spending and investment. This dynamic plays a critical role in managing economic cycles and preventing overheating or recessions. By examining the historical context and current trends, we can anticipate potential impacts on key sectors like the stock market and housing. This understanding helps stakeholders make informed decisions, balancing risk and opportunity in a changing economic landscape. In the following sections, we will delve deeper into how rising interest rates specifically affect the stock market and the housing sector. Interest rates are determined by central banks, such as the Federal Reserve in the United States. These rates are set based on various economic indicators, including inflation, employment levels, and GDP growth. The primary tool for managing these rates is the federal funds rate, which influences general borrowing costs across the economy. Changes in this rate can ripple through financial markets, altering the behavior of consumers and businesses alike. Higher interest rates increase the cost of borrowing, affecting how companies finance their operations and expansion plans. For consumers, higher rates mean more expensive mortgages and auto loans, which can reduce discretionary spending. Interest rates also affect the valuation of assets. As rates rise, the cost of borrowing increases, and the present value of future cash flows from investments like stocks or real estate decreases. This shift can lead to adjustments in asset prices, aligning them with the new cost of capital. International capital flows are also influenced by interest rate differentials between countries. Higher domestic rates can attract foreign capital, strengthening the local currency but potentially impacting export competitiveness. This global dimension adds another layer of complexity to the rate-setting decisions of central banks and their consequences on the domestic economy. Throughout history, interest rates have played a pivotal role in shaping economic landscapes. For instance, the high interest rates of the early 1980s in the United States, aimed at curbing the rampant inflation of the late 1970s, led to a significant economic slowdown. However, they were also instrumental in stabilizing prices and laying the groundwork for future growth. In contrast, the low interest rates post-2008 financial crisis were designed to foster recovery by encouraging spending and investment. The tech boom of the late 1990s and the housing bubble of the mid-2000s also offer insights into how interest rates can fuel asset bubbles. Low rates during these periods made borrowing cheap, encouraging speculative investments in technology stocks and real estate. When rates eventually increased, these bubbles burst, leading to sharp corrections in both markets. Reflecting on these historical examples helps us understand the cyclical nature of interest rates and their consequential impacts on the economy. By learning from past outcomes, policymakers and investors can better navigate the complexities of rate adjustments and their potential ripple effects across different economic sectors. When interest rates rise, the immediate reaction in the stock market can be quite pronounced. Higher rates increase the cost of borrowing, making it more expensive for companies to finance operations and expansion. This increase can lead to a decrease in corporate profits, particularly for those companies reliant on debt. As a result, investors often reassess the value of stocks, leading to potential declines in market indices. Moreover, rising rates affect investor sentiment and risk appetite. As borrowing costs climb, the attractiveness of riskier assets like stocks tends to diminish. Instead, investors might seek refuge in safer assets such as bonds, whose yields become more competitive as interest rates increase. This shift can exacerbate the sell-off in stocks, leading to increased market volatility. Certain sectors within the stock market react more sensitively to interest rate hikes. For instance, sectors like real estate and utilities, which are heavily dependent on borrowing, are typically more adversely affected. Understanding these sector-specific impacts is crucial for investors navigating a high-rate environment. Over the long term, Sustained high interest rates shape the stock market landscape in fundamental ways. One of the most significant impacts is the reevaluation of investment valuations. Higher rates affect the discount rates used in valuing future cash flows. This recalibration can lead to a sustained lower valuation for stocks, particularly if the high-rate environment persists. High interest rates can constrict economic growth by making borrowing more expensive. This slowdown affects corporate earnings growth, which is a key driver of stock prices. Companies may find it more challenging to expand and generate higher profits, which can dampen investor enthusiasm for equities. Over time, this can lead to a bearish market environment with subdued investment returns. While capital-intensive industries might struggle, sectors that are less dependent on borrowing or those that benefit from higher interest rates, like certain financial services, might perform relatively well. Diversification across different sectors can therefore be a crucial strategy for equity investors in a high-rate environment. Investors need to consider these broader economic interactions when assessing the long-term impact of high interest rates on stock portfolios. The housing market is notably sensitive to changes in interest rates given the reliance on mortgage financing for home purchases. When rates rise, the cost of obtaining a mortgage increases, directly affecting the affordability of homes. This increase can lead to a slowdown in home buying activity, as potential buyers may find it more challenging to secure financing or may be deterred by the higher monthly payments. Moreover, higher interest rates can decrease the demand for refinancing. Homeowners who might have considered refinancing their mortgages to take advantage of lower rates often postpone or abandon these plans when rates climb. Generally, as borrowing costs increase and demand decreases, there can be downward pressure on home prices. Sellers might have to adjust their price expectations to attract buyers in a higher rate environment, which can lead to a market correction if the rate increases are significant and sustained. Other factors such as housing supply, demographic trends, and economic conditions also play essential roles. In the short term, the housing market can exhibit rapid and sometimes severe reactions to increases in interest rates. Initially, there may be a surge in activity as potential buyers rush to lock in rates before they climb higher, leading to a temporary boost in sales. However, this is often followed by a slowdown as the new higher rates begin to deter new buyers. The affordability index, which measures the average person's ability to purchase a home, typically worsens as rates rise. This change can have a pronounced effect on first-time home buyers who may find it increasingly difficult to enter the market. The construction industry might scale back new developments if they anticipate decreased demand due to higher financing costs. Real estate investors play a crucial role during these periods of volatility. Looking beyond the immediate fluctuations, the long-term implications of rising interest rates for home buyers and sellers can be profound. For buyers, the era of exceptionally low mortgage rates has provided unprecedented affordability and access to the housing market. As rates rise, this window of opportunity may gradually close, leading to a more challenging environment for acquiring property. For existing homeowners, higher rates mean that the cost of maintaining mortgage repayments can increase, particularly for those with variable rate mortgages. Sellers may find that they need to adjust their expectations regarding home values and the time it takes to sell their properties. In a high-rate environment, homes might stay on the market longer, and sellers might need to be more negotiable on price. Strategically, both buyers and sellers need to be more informed and cautious. This strategic shift requires both parties to adapt to the new economic landscape shaped by higher interest rates. Predicting the future trajectory of interest rates is a challenging task, influenced by a wide range of economic indicators and policy decisions. However, understanding potential trends can help stakeholders make more informed decisions. Economists generally use current economic health, inflation trends, and global economic conditions to forecast rate movements. If the economy is growing robustly with rising inflation, central banks may continue to raise rates to prevent overheating. Conversely, if economic growth slows or inflation rates decrease, there might be a case for lowering rates to stimulate spending and investment. Global factors such as international trade, political stability, and economic policies in other major economies also affect domestic interest rates. For investors and homeowners, staying updated with these predictions and adjusting their strategies accordingly is crucial. Investors facing a high-rate environment must adapt their strategies to manage risk and seek returns effectively. One approach is to shift towards fixed income securities such as bonds, which typically benefit from higher yields in such scenarios. Diversifying into these assets can provide stability and predictable income streams, offsetting the volatility in equity markets. Equity investors might focus on sectors that traditionally perform well during periods of high interest rates, such as financials, which can benefit from wider interest margins. Another strategy is to explore international markets where interest rates may be lower or economic conditions different. This geographical diversification can help mitigate the impact of domestic rate increases and take advantage of growth opportunities in other regions. Finally, utilizing financial derivatives and hedging techniques can be another way to manage interest rate risks. Homeowners, particularly those with adjustable rate mortgages, need to consider various adaptive measures to manage the impact of rising interest rates. One of the most straightforward strategies is refinancing to a fixed-rate mortgage, which can provide certainty in monthly payments and protect against future rate increases. Another approach is to accelerate mortgage payments when possible. Making extra principal payments can reduce the total interest paid over the life of the loan and shorten the loan's duration. For those looking to buy, considering less conventional types of mortgages that offer lower initial rates, such as adjustable rate mortgages with longer fixed rate periods or interest-only loans, might be worthwhile. Homeowners should also consider their housing needs and the possibility of downsizing or relocating to more affordable areas. It's essential for homeowners to assess their financial situation comprehensively and consider all available options to adapt effectively to a high interest rate environment.